Hello and welcome to this explainer. Today, we are going to uncover the cheat codes to the stock market. Tell me, have you ever felt like the market is specifically rigged against you? Like someone is sitting right behind a screen, watching your exact moves and pressing the reverse button the very second you enter a trade? Well, you are not alone. It's a feeling literally every new trader experiences. But today, we're going to learn how to stop being manipulated by institutional money and these big players. Instead, we're going to hack the seller's mindset so you can start trading right alongside them.
So let's just dive straight into this very painful yet very common question. Why do retail traders buy a breakout only to watch the market immediately reverse and hit their stop loss? It is a shared trauma for almost anyone who has ever looked at a chart. You see this big, beautiful green candle breaking past a key resistance level, you buy at the exact top of it, and instantly your capital just vanishes as the market violently turns against you. Today we're going to reveal exactly why this trap happens and, more importantly, how to prevent yourself from ever falling for it again.
Here is our quick agenda for this explainer. 1. Market structure and trends. 2. Avoid the breakout trap. 3. Master the retest strategy. 4. Trading sideways markets. And finally, 5. Essential candlesticks and patterns. Let's get started.
Section 1. Market structure and trends.
You see, a true uptrend or a bull trend, it isn't just a straight line pointing to the sky. No, it consistently creates higher highs and higher lows. This beautiful stair-step motion tells us that the buying pressure is actually sustaining. When the market is in a healthy uptrend, the next high is pushed higher than the previous one, and the pullbacks, or the lows, they settle higher than the previous lows. This simply signifies that buyers are eager to step in earlier and earlier during any dip. But as traders, we must also remember that an uptrend can reverse at any time, right? We know that shift is happening the exact moment a lower high is formed. That signals the structural end of the trend.
Now notice the striking difference here. The bad trend on the left shoots up almost vertically. Direct, uninterrupted buying pressure like this simply doesn't sustain for a long time. It has absolutely no structural foundation, which makes it highly erratic and frequently forms a massive trap for late buyers. On the other hand, the good trend on the right takes its time. It has that stable stair-step structure we just talked about. This proves that there's underlying support being built at each new level. So when the market inevitably pulls back, that structure provides a much-needed safety net.
Moving to Section 2. Avoid the breakout trap.
Novice traders consistently fall for 3 deadly sins. Number 1, entering on a direct breakout. Because they're initially taught to buy the moment a line is crossed, they blindly enter without waiting for any proper confirmation. Number 2, trading on big candles. They see a massive green candle, and their brain automatically assumes it guarantees huge continued momentum. They don't realize the institutional move might already be completely over. And number 3, FOMO, or the fear of missing out. The absolute panic that a profitable trade is escaping them completely overrides their logic, causing them to hit that buy button at the worst possible moment.
Just look at this specific moment on the chart. The market has been trending down, held lower by a clear resistance trend line. Suddenly, boom, there is a big candle breakout. The new trader sees this, feels the intense fear of missing out, and enters the trade right at the top. But here is the secret. Big players know retail traders enthusiastically enter on breakouts. The institutions deliberately create these fake breakouts to invite amateur buyers in. Why? Because they need that liquidity to sell their own massive positions. The very moment the retailers buy, the big players sell into them, immediately reversing the price and hitting all of those newly placed stop losses. The novice trader is simply crushed by the reversal.
Section 3. Master the retest strategy.
The difference in mindset here is truly night and day. While the retailer blindly buys the initial breakout out of fear and gets trapped, the smart trader does something completely different. The smart trader patiently waits. They actually want to see a pullback. They wait for the market to come back down and prove its strength. They want the market to show them definitively that the broken resistance level has genuinely turned into a solid new support level before risking a single dollar. You can achieve a massive structural edge in the market by following these exact disciplined steps. First, let the trend line break. Just observe it. Keep your hands off the keyboard. Second, watch for the nearest lower swing level to break as well, confirming the shift in momentum. And finally, third, wait for the price to come back down to retest that broken level. It is this retest, usually marked by the formation of a specific candlestick pattern right at this zone, that gives you the true, high-probability confirmation to finally enter the market.
There are 2 highly effective methods for entry here. On the left, we have the trend line retest, where the price breaks the diagonal resistance line and then falls back down to bounce directly off of it, effectively turning it into diagonal support. Now, on the right, we have the swing retest, where the price breaks a horizontal swing level and comes back down to retest that exact flat zone. Both of these are absolutely critical points of confirmation where the smart money is actually stepping in to defend the new trend.
So the crucial point to remember is this: patience pays off immensely. By adopting this hacker mindset, ignoring the initial flashy breakout, and waiting for the structural retest, the source materials indicate your trading accuracy can skyrocket to an incredible 80 to 90%. Think about that. You are no longer gambling on a momentum rush. You're trading on confirmed market structure, riding the wave alongside the institutional players instead of acting as their exit liquidity.
Let's see how this builds into a complete professional trade. When you combine the retest entry with proper risk management, you get a setup exactly like this. The smart trader waits for the breakdown, waits for the price to pull back to the trend line, that is the retest, and enters precisely there. Because they entered at a logical structural point, they can place a tight stop loss just above that retest point. If the price goes above that, well, the thesis is invalidated. This tight stop is what shields them from massive losses. Then, they target the previous lower swings for their first and second take-profit targets. This is calculated, disciplined trading at its absolute finest.
Section 4. Trading sideways markets.
New traders often look at a sideways, ranging market and wrongly assume it's a gold mine of easy money. They look at the chart, smile, and confidently tell themselves this exact, dangerous quote: "Oh, it's so easy. I will just sell at resistance and buy at support." It seems like a flawless plan, right? Just play the ping-pong game back and forth between the two lines. But trust me, this naive mindset is exactly why a sideways market will drain your account completely dry.
Because here is the truth. Big players, the smart money, they absolutely know you are trying to trade that range. They clearly see the massive pools of liquidity building up just above the resistance line and just below the support line. Why? Because that is exactly where everyone's stop losses are sitting. So, they intentionally trigger fake breakouts on both ends of the range. They push the price slightly above resistance to hit the short seller's stops, and then quickly drop it completely below support to hit the buyer's stops. This aggressive stop-loss hunting results in back-to-back losses for the retail trader. If you get trapped twice in a sideways market, the best rule is to just step back, protect your capital, and wait for a definitive, retested breakout from the entire range.
And finally, Section 5, Essential Candlesticks and Patterns.
Let's do a quick refresher on the basics. A candlestick chart is simply a visual representation of price action over a specific time period, whether that's a 5-minute chart, a 1-hour chart, or a daily chart. Green candles show the closing price is higher than the opening, meaning buyers won that session. Red candles show the closing is lower, meaning sellers won. The wicks, they show the extreme highs and lows. Together, they tell the visual story of the intense battle between buyers and sellers in that exact window of time.
Now, there are dozens of patterns you can study, from hammers and engulfing candles to dojis and morning stars. But here's the secret that most online resources just won't emphasize enough. While you can memorize all of these essential configurations from a comprehensive guide, they are completely useless in isolation. They will absolutely fail you if you do not combine them with the foundational market structure principles we just covered. A beautiful bullish engulfing candle means absolutely nothing if it happens right under major structural resistance. Context is everything in trading.
For example, let's look at this triple top chart pattern. It's a classic reversal pattern showing 3 distinct attempts to break a high. But notice what makes it actually actionable. The smart trader doesn't just sell at the third top hoping it holds. No, they wait for the price to fall and definitively break the neckline, which is the structural support at the very bottom of the pattern. Furthermore, they look for trading volume to increase to confirm this breakdown. The visual pattern is just the warning sign, you see. The structural break of the neckline is the actual green light to enter the trade.
The ultimate takeaway from this explainer is precisely this: never trade a pattern or a breakout blindly. We are so heavily conditioned to enter trades the second a pattern breaks a line, but the harsh truth is that patterns frequently fail because new traders completely ignore the prior structural levels. The structure dictates the pattern, not the other way around. If you don't look left on the chart and carefully analyze the previous structure, you're just setting yourself up to be trapped by the big players.
So, I want to leave you with a question to ponder today. The next time you are watching a chart and you see a massive green candle violently surge past a resistance line, and you start to feel that intense fear of missing out creeping into your chest, what will you do? Are you going to be the retail trader trapped at the very top, handing over your hard-earned capital to the institutions? Or will you be the smart trader, hacking the seller's mindset and waiting patiently for the rescue of the retest? The choice is entirely yours. Keep learning, stay patient, and trade smart.